Imagine waking up to see $50,000 glowing on your screen, only to realize those digits are ghosts you can no longer touch. Your bank doors are locked, the ATM is dead, and the system hasn't exploded, it has frozen. You are about to discover the brutal reality of the 1933 National Bank holiday. True wealth isn't the number in your account, it is the liquidity you can actually reach when the world stops. Imagine waking up on a routine Tuesday morning, moving through the motions of a standard day without a hint of the impending silence. You open your banking app, and the interface remains reassuringly familiar. The digits, $20,000, $50,000, or perhaps a more substantial sum, glow with the same digital warmth they did just 24 hours ago. This visual confirmation provides a sense of security, yet it is a profound illusion. When you attempt to transfer funds to cover your rent, the screen hangs. A quick refresh brings no resolution. At the local ATM, your card is flatly denied. Panic begins to set in as you dial the service line only to find it perpetually busy. Finally, you drive to the physical branch, only to be met by heavy glass doors and a cold, printed notice announcing a temporary suspension of operations. In this precise moment, your capital still exists in a legal and mathematical sense, but it has become an untouchable ghost. You cannot move it, you cannot spend it, and you cannot touch the wealth you allegedly own. This scenario illustrates a truth that financial historians have observed for centuries with mechanical precision. A systemic collapse is rarely a loud explosion of disappearing value, but rather a silent, crystalline freeze of the entire infrastructure. It is comparable to a complex engine that hasn't run out of fuel but has suddenly had its moving parts seized by ice. While most people fear the total evaporation of the dollar, the documented reality of financial stress suggests that the real danger lies in the locking of the gears. Liquidity does not simply vanish into thin air, it becomes trapped behind a wall of institutional paralysis. The critical question during such a crisis is never how much wealth you have accumulated on paper, but whether you possess the physical reach to grasp it. This mechanical failure was most famously demonstrated in the winter of 1933 during the American banking crisis. On March 6, President Franklin Roosevelt took the unprecedented step of declaring a national bank holiday, effectively sealing every vault in the United States. For 4 agonizing days, and in many communities, significantly longer, citizens were prohibited from making withdrawals. This was not a failure of the currency itself, nor was it the chaotic hyperinflation often seen in collapsing regimes. The dollar remained the legal tender. Instead, it was a systemic shutdown triggered by a total evaporation of trust. Banks had funneled deposits into long-term illiquid investments that could not be instantly liquidated to meet the frantic demands of a panicked public. The mismatch between what people believed they could access and what banks could actually deliver created a cascade, and the cascade forced the shutdown. What happened during those days reveals a truth that most people never confront until it is too late. The harsh reality is that a bank balance is not actually money, it is a promise. It represents a legal claim that the financial institution holding a deposit will honor that credit whenever a customer asks for it. However, a promise is only as reliable as the underlying system's capacity to fulfill it. When a critical mass of people attempts to call in those promises at the same moment, the foundation of modern finance reveals its structural frailty. This is the inherent paradox of fractional reserve banking. This system operates with remarkable efficiency during periods of economic calm, acting as a powerful engine for growth, yet it is fundamentally prone to collapse the moment panic takes hold. It was never engineered to return everyone's capital simultaneously, and the Emergency Banking Act was far more than a simple operational restart. It was a brutal restructuring of financial access. Under this legislative hammer, only the institutions deemed solvent were granted the right to reopen their doors. The weaker, more fragile banks remained shuttered, leaving the deposits within them frozen indefinitely. In these cases, the government did not technically seize the wealth, rather, the system simply lacked the physical and liquid means to deliver it. This created a stark divide where access, rather than nominal ownership, became the only variable that mattered for survival. Those lucky enough to be parked in stronger banks regained their liquidity within a few days, while those in failing institutions faced months or even years of waiting, often recovering only a small fraction of their original balances. This brings us to the axis upon which financial survival truly turns, the distinction between nominal wealth and accessible wealth. Wealth that cannot be mobilized is not wealth at all. It is merely a frozen claim, a set of digits on a ledger that lack any real purchasing power because the connection between owning an asset and using it has been severed. True liquidity is the power to convert an asset into usable cash quickly and without a significant loss in value. While a house is undoubtedly wealth, it is famously illiquid. A bank deposit is intended to be the opposite, perfectly liquid and available on demand, but the moment a bank closes, that liquidity evaporates. The asset exists in the abstract, but the system ceases because the ability to use that value has vanished. This is what happened in Germany during the early 1920s. The Weimar hyperinflation is often remembered for images of people carrying wheelbarrows of cash to buy bread. While history focuses on the sheer volume of paper currency during the Weimar era, the initial fracture was actually caused by a fundamental failure of access. As the currency began to destabilize, the internal plumbing of banks and businesses began to leak, leading to massive operational struggles and agonizingly delayed payments. For those with savings locked in the banking system, a brutal reality set in. Even when withdrawals were technically permitted, the institution simply could not dispense physical currency fast enough to keep pace with the vertical climb of inflation. In such a scenario, the clock becomes a predator. By the time you finally received your money, its original purchasing power had been incinerated, making the bank's processing delay a stealthy form of wealth confiscation. Conversely, individuals who held tangible physical goods, real estate, or foreign currency managed to preserve their status because they controlled assets that functioned independently of the banking system's broken transaction architecture. This erosion follows a predictable, three-act progression. It begins with stage 1, friction. Here, the system is still functioning but noticeably straining, transactions take longer to clear, and withdrawals face subtle delays often excused by technical glitches or temporary cash shortages. This evolves into stage 2, restriction, where formal controls replace excuses. Authorities announce daily withdrawal limits and block transfers to foreign accounts, framing these draconian measures as temporary safeguards for stability. In reality, this stage serves to sever the vital cord between an account balance and its actual usability. The final descent is stage 3, closure, a total blackout where banks shut their doors, markets suspend all trading, and payment systems go dark. At this point, liquidity has not merely decreased, it has effectively ceased to exist. The 2015 crisis in Greece serves as a modern, clinical example of this progression. As negotiations between the Greek government and its creditors disintegrated, the looming fear of an exit from the Eurozone triggered a massive, accelerated outflow of euros. By late June, the European Central Bank refused to extend further emergency liquidity, forcing a climax. On June 28, the Greek government officially announced capital controls, and banks remained closed for weeks. ATMs were operational but restricted citizens to a mere €60 per day. In the wake of these restrictions, credit and debit cards were rendered useful only for domestic transactions, while the flow of international payments ground to a halt. This severed the vital arteries of the economy. Businesses reliant on imported goods found themselves paralyzed, unable to settle debts with their global suppliers. The entire economic landscape fractured as access replaced capital as the world's scarcest resource. One must consider what fundamental lessons were etched into the public consciousness during those chaotic weeks. The primary revelation was that maintaining a bank account denominated in euros did not guarantee the ability to actually use those euros. It became clear that electronic digits are only as dependable as the fragile infrastructure sustaining them. In contrast, physical cash, while technically the same currency as a digital deposit, revealed itself to be a different species of asset. It acts like a master key that requires no permission from a third-party gatekeeper to turn. Those who possessed the foresight to withdraw cash before the gates slammed shut maintained a strategic advantage known as optionality. They retained the power to transact, purchase necessities, and move resources freely, while those who trusted the digital ledger remained trapped. The money remained on the books, but the bridge to reach it had collapsed. This distinction highlights the core mechanism of financial survival, optionality. Unlike diversification, which merely spreads risk across different asset classes like stocks or real estate to maximize a return on investment, optionality focuses on spreading access across multiple independent systems to preserve functionality. It is the difference between having different types of fuel and having multiple separate engines. If you own a diverse portfolio of bonds and equities but hold them all through a single brokerage that freezes, your diversification offers no shield. This brings us to the concept of counterparty risk, the ever-present shadow that follows every financial claim. It is the danger that the institution on the other side of your contract will fail to honor its word. In stable times, these counterparties remain invisible, but during a systemic tremor, they become the only factor that matters. Your asset is only as secure as the weakest link in the chain of institutions required to honor it. The financial crisis of 2008 was fundamentally a counterparty crisis. The collapse of Lehman Brothers serves as a stark historical warning, demonstrating that an institution fails the moment peers lose faith in its ability to meet its obligations. When counterparties recoil, liquidity drains out of the system instantly. On paper, Lehman held assets worth billions, yet those billions were useless because they could not be converted into cash in a market where no one wanted to be on the other side of a trade with a sinking ship. This systemic freeze radiated outward with terrifying speed, causing money market funds to break the buck and forcing the Federal Reserve and the Treasury to intervene with extraordinary measures. Without such a massive injection of life support, the paralysis would have inevitably reached every ordinary business and depositor on the street. Today, digital payment systems have introduced a new set of efficiencies, but they have also birthed lethal vulnerabilities. The traditional bank run, which once crawled over the course of days, now unfolds in a matter of hours. In 2023, Silicon Valley Bank collapsed in less than 48 hours after online news triggered a stampede, leading depositors to pull billions of dollars in a single breath. The lethal combination of viral information and instantaneous digital transactions created a run faster than any regulatory intervention could possibly hope to block. In this high-speed environment, the distinction between having money on a ledger and actually accessing that money has become the only metric that matters. This brings us to the unique properties of physical cash, a bearer instrument where possession is the only definition of ownership. Cash is an outlier in the digital age because it requires no bank for access, no electricity for use, and no third-party permission to spend. History verified this during the Greek capital controls, where those who held physical currency retained their power to transact while others were locked out. Cash is certainly not an investment, it actively loses value to inflation, but it serves as vital insurance against a total failure of access. How does one position themselves to survive when trust disintegrates and the system locks up? The strategy is built on principles of redundancy and multi-layer liquidity. You must avoid dependence on any single institution by spreading your holdings across multiple banks and brokerages. This is not a matter of paranoia, it is a matter of sound financial engineering. To maintain a functional life during a crisis, you must keep assets in highly liquid forms like cash and short-term securities, even if their returns are minimal. Furthermore, true security requires holding assets that exist entirely outside of intermediaries, such as physical precious metals or tangible goods with proven resale value. Moving beyond physical assets, survival requires an acute awareness of counterparty chains. One must identify every single entity standing between themselves and their wealth, acknowledging that the danger is like a fraying rope where every additional knot increases the chance of a snap. The longer that chain of intermediaries, the greater the inherent risk to the principal. True financial resilience also demands a high degree of flexibility and a constant preparedness to adapt as environmental conditions shift. While no perfect hedge exists to provide a total guarantee against systemic collapse, the focus of a sophisticated strategy must be on probabilities rather than certainties. The objective is to increase the mathematical odds that when general access disappears for the majority, a person still maintains open pathways to their resources. By structuring holdings to eliminate any single point of failure, the risk of being wiped out by a single institutional default is mitigated. The historical record remains remarkably clear on this point. Financial systems do not just fail, they freeze. This pattern has repeated itself with haunting consistency across different countries, various currencies, and divergent political systems. The sequence is always the same: access disappears long before the money itself vanishes, and liquidity is paralyzed well before a currency actually collapses. Those who have prepared by building redundancy and optionality into their portfolios navigate these freezes far better than those who have ignored the structural warnings. The global financial system will inevitably be tested again. This is not a prediction rooted in malice or conspiracy, but a recognition that complexity inherently breeds fragility. Fragile systems break whenever they are sufficiently stressed. The real question is not whether another crisis will arrive, but whether an individual is positioned to navigate the terrain when it does. The choice is between being trapped in a desperate queue, waiting for non-responsive institutions to restore access, or being among those who maintained alternatives and understood that true survival depends on reach. When the next freeze arrives, the unprepared will discover that wealth without access is nothing more than a frozen promise trapped in a locked vault. The only value that remains is the wealth that can be held, the value that can be moved, and the resources that can